Now let's talk about tax, and in particular tax savings. I've already made some mention of this, so let's get a little bit more specific. We know that tax is assessed on a firm's taxable income, right? Now tax law, because it's concerned about the reliability of numbers, involves measuring things a little bit differently than accounting. Although we're going to fudge that difference just a little bit here and assume it away a little bit. But the key thing you need to know is that tax is calculated based on taxable income. We're going to assume it's a percentage, although sometimes there are some other rebates and some other offsets that make it not exactly quite like that. So the other thing we need to know, well, income tax is a major cash outflow, right? If you're making profits on a project, a reasonable chunk of that in Australia at the moment, 30% for large companies, will go out as tax. So to think about the after-tax net cash inflow, in other words, we want to talk about all of our basic cash flows, and we need to take off the cash flow that goes to the tax office. You would think that the simplest way of doing this would be to take our net cash inflow and just multiply it by 1 minus the tax rate. So if the tax rate is 30%, the amount of the cash inflow that remains to you is 70%. Now, that is not the full story, because you know it's not cash inflows that are taxed, unless accrual accounting doesn't give you much difference in your business between accrual accounting and tax. But tax rules don't generally tax cash income. They tax a form of profit, and a form of profit that's specified by the tax rules. So what we need to do, even after we've calculated the cash inflow, the net cash inflow, off on the side somewhere, we've got to go and work out what the accounting profit is, and then make the adjustments that turn that accounting into a tax profit under tax law, and then that enables us to determine how much tax is paid. Now, we're not going to introduce huge complications to this, but we're going to make sure that we take into account the tax effect. So we're going to simplify a bit here. We're basically going to say that the only difference between our cash flows and our tax measure of profit is depreciation. So everything else that appears on as part of your EBIT is going to be part of your net cash flow. It'll be taxed. Okay. Now, remember that earnings before interest and tax, we're not including interest, we're not including tax, it's before that. Earnings before interest and tax, simplifying, is just all of our cash flows less depreciation. So if you like, that's a measure of profit. And it's profit that is being taxed. So if we basically calculate earnings, okay, this earnings includes non-cash depreciation, then EBIT is something that is taxed. So we can calculate tax on that, right? Tax is going to be TC of EBIT. So we are left with 1 minus TC of EBIT. So that basically takes away the tax. But then you have to remember, whoa, hang on. In calculated earnings, we had cash flow and we had depreciation. We took off depreciation in getting to that. But depreciation is not a real cash expense. So add it back at the end. And that basically allows you to have a number here that allows you to calculate tax. And then once you've used that to calculate tax, you add back the bit of this that you took off that wasn't cash, i.e. your depreciation. Okay, let's talk a little bit about how depreciation works. Essentially, depreciation is the allocation of a cost of an asset over a period of time. So if I buy an asset for 100, it's going to last me 5 years, and I expect it to have zero value when it finishes. It makes sense to say that I've used up $20 of that asset each year. Okay, so if we're depreciating over 5 years, we would say 20% per annum of the value, the initial value of the asset, is depreciated away. Now, we can do this for tax, and this is generally how it's calculated for calculating profit for tax purposes. For accounting profit, that might be slightly different, because accounting rules are trying to achieve something different than tax rules. Tax rules are trying to make sure you've got a reliable tax base that can't be fudged by estimates, whereas accounting likes estimates because they make information more relevant. Okay, so we're basically interested in not accounting depreciation that is used to calculate profit for accounting purposes, but the depreciation that is allowed to be calculated for tax rules. Okay, if we're talking about depreciation, we also need to talk about the fact that there is a salvage value of the asset. Once you finish using an asset can be sold, and you might actually sell it before it gets to the end of its useful life. Now, an important thing to understand is that when we calculate depreciation, we are calculating a loss in service potential that's based on an estimate. There's no reason that the reduction in the asset due to our depreciation calculation should necessarily track that asset's real market value. I mean, we can't see the future. So this is going to be a rough calculation. Now, if we get to the end of the asset's useful life, or we get close to the end, we're deciding we're shutting down the project and we're selling the asset, and the asset isn't totally used up, then we've got to look at the difference between the cash flow and what the asset is recorded at in our records. And why do we need to do that? Because if there is a difference between what the asset is recorded at and what we're getting for it, then at the time of getting rid of the asset, there's a loss, right? In this case, if we're getting rid of an asset that's recorded at 500, we're removing an asset of 500, we're bringing in cash of 340, there's a missing debit. There's a loss that needs to be recorded. Now, that loss is effectively saying that you haven't done enough depreciation over the life of the asset. When you calculated your depreciation, you recognized a value loss or a consumption of service down to 500, but it turns out when you sold it, it's only worth 340. So there's actually been a bigger loss of service than you claimed. Now, that loss is something that is deductible for tax purposes. Australian tax legislation allows you to say, well, look, okay, we did an estimate according to your rules of what the expense was, and we've depreciated it down to 500, and now here we are at the end of the asset's useful life, we're getting rid of it, but its value isn't 500, it's actually 340. So that extra depreciation, if you like, the under depreciation or the not enough depreciation we've done, is available as a deduction. So when you get rid of the asset at the end, if you sell it for a sale value that's less than the book value, you've got a loss. And the tax effect of that, what does it do? That loss gives you an extra deduction, so it reduces the amount of tax you pay. So if you like, you've basically got an extra tax saving, an extra cash flow that happens at the time you dispose of that asset. Right? So that's important. It's something you need to think about.